which is the 404, plus the income of the expenses. So basically, our retained earnings section is going to be, we started with 420, and what did we, verify the answers, prepare a worksheet. So basically, the retained earnings, we started with 420. Does it tell us the income?
It's at the beginning of the period, so I think it just stays at that 420. It says 1/115.
So we need to show here we'll reduce from that figure the amounts paid to accountants. Do you know what I'm saying? Because that's going to make a difference. Parent company balance less the $30,000 in professional fees plus the $115,000 gain on the gain of the transaction. So basically, this 420 is going to be the $115,000 gain. That's going to make it 535 minus the $12,000 fees, and excuse me, not the $12,000 fees, minus the $30,000 fees for the professional and liability. We need to adjust in there. So our retained earnings, again, this should be a plus. We're going to do this on a worksheet. I'm trying to just figure it out, and we'll see. 2,183,700, but still my liabilities and equity is off here, and it would be right if I put the 400,000 in for Tucker. No. What am I doing wrong here? What? 515, that's my issue. There. Okay, so guys, I'm basically trying to use these various ways to figure out what our new balances are going to be in the consolidated. Let's use the worksheet to determine this, okay? Because I'm basically trying to add and subtract on my own. So let's start and let's look at basically taking this worksheet based on the various transactions we made that get recorded against Tucker. So when we, against the parent company. So if we start with that balance shown on the books, and then if we take these various transactions here and add these transactions to the balance of the parent company, our investment in Tucker will add $515,000 in here. When we show the common stock at par, the paperwork or the book shows the common stock of 110, right? And then if we add the 20,000, we end up with common stock of 20. If we show the additional paid in capital of 180, what does the book show the additional paid in capital was? It showed 360, didn't it?
Yep.
So if we add the 180 and then subtract out the stock issuance fees, we come up with 528. If we, from our cash, whatever we started was 60,000, if we show these journal entries of cash minus 30, cash minus 12, we come up with our 18,000. Our long-term liabilities were previously 430 with the main company. If we add 200,000, we're up at 630. So basically, I should have created another thing to show what the book says, and then adjustments to then come up with the new balance after they acquired it. So basically, we took all of these transactions here and recorded them against Marshall, okay, to come up with the new balance sheet for Marshall. The retained earnings needs to immediately reflect the gain on the bargain purchase. Then we've got Tucker, the 20, the 90, 140, everything shows here. Now, part of the acquisition needs to report these items at fair value, okay? So the 30, the 20, and the 5 go against the Tucker investment of $515 to record $55,000 adjusted for the fair value. Now the next thing we need to do is show wiping out the stockholders' equity section of Tucker by zeroing the 120 and the 340, which gives me 460. If we wipe that out, look what happens here. Our new balance, we're getting rid of the investment section of Tucker. We also are removing the common stock from Tucker and the retained earnings from Tucker. So the consolidated financial statement is going to consist of the new balance after acquiring Tucker, okay? So it's what the book shows plus the journal entries we just did to purchase Tucker. Then we have Tucker's balances. We adjust for the fair value, and we get rid of the stockholders' equity section. This is, guys, on the test, you're not going to have something this complicated. You'll have pieces. Do you know what I'm trying to say? You won't have from start to finish. I'll have something like, here are the book values. They purchased, the consideration was for X. The fair values were this. What's the gain? Or what's the goodwill? Do you see what I'm saying? This is a lot putting it all together. Or I might say, show me the journal entry to acquire the subsidiary, knowing that you issued common stock of $2 million with a par value of $5 and 300,000 shares, and the rest was cash. Do you understand? So you'll have pieces of